Hello, dear friends. Today we will be discussing about the assumptions, accounting assumptions, fundamental accounting assumptions. Assumptions are those concepts which are presumed to have been followed while preparing the annual accounts in any business enterprise. Basically, we have three important assumptions: going concern assumption, consistency assumption, accrual assumptions. With this arrow, I have tried to come up with in brief what these assumptions means. So let's start with the going concern assumption. The arrow goes here. It has been assumed that business shall continue for a foreseeable period. That simply means when you start a business or when you come up or you invest your heavy investment in machineries or building and any place where you are or where you are open up to start a setup, it has been assumed that the setup will goes for a good number of years. For example, machinery, you purchase a machinery, right, for the manufacturing purposes. So we assume that the life of machinery may be 10 years or 15 years. It could run for 10 or 15 years. So for the 10 and 15 years, we what we do in accounting procedure, we will divide those cost of machinery into 10 years or 15 years. Like cost is spread over the next 10 years for ascertaining the profit and loss of each year. Though we are purchasing machinery in the first year, but we will deduct the deduct a few percentage which has been named as a depreciation. We will be discussing about depreciation in my coming videos, but just for the sake of understanding, take it in an example. If you purchase a machinery, it is assumed that it could run for 10 years or 15 years. While accounting or while recording the accounting calculations, what we will be doing, we will divide the cost of machinery into its life period. That represents that we are assuming that our concern is a going concern. That means it is not going to we are not going to stop the operations in a short span. It is going to run for a long span. Then another is your consistency assumptions. Consistency, I'm taking the same example of depreciation. See, we have many methods of calculating depreciation, but when you say consistency, that means you are going to stick with some of the principles or a method of applying depreciation. It may be either written down value, or in short WDV, or SLM, straight line method. So accounting practice may change if the law or accounting standard requires it to change for a meaningful presentation. You can switch over from WDV to SLM and SLM to WDV as per the law or your accounting standard, and if it's important for your presentation. So consistency. But initially it has been a good practice if you follow the same charging method. But if your business require, or if it becomes important, if there is any change in the accounting standard or law, then for the meaningful presentations you may change your method. Then the last is your accrual assumptions. Here you can see revenue is recognized when it is realized, that is when sale is completed or services are rendered. Just an example, say for if you made a purchase or on 1st of January, right, you have to record that purchase on 1st of January itself, though you are paying it after 2 months. Got it? So revenue, or if it's an expenditures, it is basically it is said as per the assumptions, accrual assumptions. For example, if you made a sale on 1st of January, though you are going to get money after 2 months, the same example of purchasing and in sale, in that case you have to record the transactions of selling on that immediate effect. If you are making a sale on 1st of January, you have to record on the 1st of January. It doesn't matter when you are getting the money, right? So accrual assumptions, sale is made, revenue is recognized, that is when sale is completed or services are rendered.